Hi everyone, my name is Manvi Walia. Welcome back to my channel. In our last video, we learned about financial statements and their components. Today, let's take it a step further and learn how to analyze these statements easily, even if you are a beginner. This will help you make better decisions whether you are a business owner, investor, or just someone interested in finance. Let's begin with two simple ways to analyze financial statements: vertical and horizontal analysis. Vertical analysis is about understanding what percentage each item is of the total. For example, how much of your revenue goes to paying rent, salaries, or expenses. Horizontal analysis compare financial number across time, like comparing this year revenue with last year to see if it grew or fell. Let's take an example. Vertical analysis. If a company earned 10 lakh in revenue and spent 2 lakh on marketing, that 20% of revenue. If next year marketing cost goes up to 4 lakh, it is 40%. This might mean the company is overspending on marketing. Now, let's take an example about horizontal analysis. Suppose last year revenue was 8 lakh and this year it's 10 lakh. That's a 25% increase. But if expenses also increased by 30%, the profit margin may be shrinking. Now that we have learned the basic of analyzing financial statement, let's dive into something really important: ratios. Ratios are like shortcuts that give you a quick snapshot of how well a company is doing. They fall into three main categories: profitability, liquidity, and solvency. Let's take them one by one with simple example. Profitability ratio. Profitability ratio tell us how well a company is generating profit. For example, the net profit margin show the percentage of revenue left after all expenses. Just take an example. Let's take company A and company B. If a company A has a net profit margin of 50% and company B has just 8%, company A is clearly managing its expenses more efficiently. It is keeping more of its revenue as profit. Profitability is important, but what if a company cannot pay its short term bills? That's where liquidity ratios come in. Liquidity ratios help us check whether a company can meet its short term obligation. The current ratio is a popular example. Let's take an example. Just imagine a company owes 50,000 but has only 40,000 in cash or inventory. That's a current ratio of less than 1, which indicates trouble. It's like running out of money before the end of the month, definitely not ideal for any business. Liquidity covers short-term health, but what about the company long-term stability? That's where solvency ratio come into play. Solvency ratio show us how dependent a company is on borrowed money compared to its own funds. A common example is the debt to equity ratio. Just take an example. Suppose a company has a debt to equity ratio of 3 is to 1. This means 3 in debt for every one of its own money. If the industry average is 1 is to 1, the company might be taking on too much risk. Now ratio give us great insight into our company numbers, but they don't tell us the full story. For that we need to look at cash flow, the heart of any business. Cash flow analysis. Even if a company show profit on paper, it might still struggle if it does not have enough cash. Cash flow analysis show if the business generate enough cash to cover its expenses. Let's take an example. Imagine a company has 5 lakh in sales, but payment from customer are delayed, leading to a cash shortfall of 1 lakh. Even though sales are good, it might not have enough money to pay salaries or suppliers. This show why cash is more important than just profits. Now, let's look at trend to see how a company financial health is changing over time. What is trend analysis? Trend analysis is like tracking your weight every month. It helps you see if the things are improving or getting worse. Here we track revenue, expenses and profits over time. For example, let's say a company revenue is growing by 10% each year, but expenses are growing by 15%. This means profits might shrink even though sales are increasing. It is like earning more salary but spending even more. Next, Let's compare a company performance with others to get a better understanding. Why compare? Comparing with industry standards or competitors shows where a company stands. Is it doing better or worse than others? Just take an example. If the average profit margin in the industry is 12% and your company margin is 8%, this shows inefficiency. But if it's 15%, your company is doing better than most competitors. While analysis is powerful, we must also know its limitations. Financial statements don't show everything. They can miss things like the value of a company brands or its team moral. They can also have an error or intentional adjustment. For example, a company may show a profit of 1 lakh, but if there is a hidden lawsuit worth 50,000, this true picture is different. Always be cautious. Finally, let me share some practical tips to help you get started with analyzing financial statements. Tip number 1: pick a company you like and read its annual report. Tip number 2: use Excel to calculate simple ratios or create chart to spot trends. Tip number 3: look for free financial analysis templates online to practice. Let's wrap this up with a quick summary of what we learned today. Today we learned how to analyze financial statements using vertical and horizontal analysis, the importance of ratios, cash flow, and trends, how to compare with others, and the limitations to watch out for. If you found this helpful, don't forget to like, share, and subscribe. Let me know in the comment if there is a topic you would like me to cover next. This is Manvi Walia signing off. See you in the next video. Bye bye.